And so what we do at Motif is we take these expressions and we make them actionable. And we do this by turning them into what we call a motif. And a motif, very simply, is a basket of up to 30 stocks, intelligently weighted, built around one of these ideas, these concepts. And you can purchase a motif for the cost of a single stock transaction, $9.95 to buy 30 stocks in real time. That's 33 cents a ticker, going to Charles's cost of trading coming down. But what we do is we do take concepts, we bring down the cost, and more importantly, we make things super intuitive. So if you look at our customer base today, we're a tough product to market because we have newbie investors who say, this product's for me, it's so easy. And we have day traders trading a motif 20 times a day who say, this product's for me because it's easy and cheap. And that's the concept behind Motif. And what we've learned in financial services is making things easy matters more than anything. People already have an aversion to financial services, thinking they're very complicated. The social aspect of this is very important because it does a lot of things that Charles alluded to, which is bringing down costs. The average online broker acquires these customers at about $600 to $700. We're not even in the triple digits. We're in the low double digits. And power of this is unleashing the power of social. On the motifs that our customers build, they're talking about them. I built a motif. Let me go show you this. Let me go tell you about all the interesting things. Social for us is a very powerful phenomenon. But I think the point that Charles brought up this morning is the whole economic model of investing is radically shifting. And I think there's a whole set of technologies, there's a whole set of Silicon Valley technologies, and a whole set of Wall Street technologies around algorithms and all this interesting debate about Michael Lewis's book. These algos can do whatever you want. You can use them to drive alpha. You can use them to eat costs. Our algos eat costs for a living, and that's what we've chosen to invest in. And we use it as a way to disrupt and unleash value.
Hi, I'm James Herbert. I'm a co-founder and president of Lending Home. Lending Home was created to re-envision the mortgage experience overall for borrowers, originators, and investors. You know, my background was in real estate and finance, and the impetus for me to come into Lending Home was really born out of frustration out of my last two jobs, which are around running residential real estate funds and the challenges of getting mortgages for those investment properties as well as refinancing my home. Fortunately, the more and more frustrated I got from the borrower's perspective, the more it became obvious all the different ways that there were to disrupt the space that there were. Fortunately, my co-founder, Matt, who's a CTO, multi-time entrepreneur, was looking at it from the investor's perspective and seeing some of the same things from a top-down perspective that I was feeling from a bottom-up perspective. So about 9 months ago, we created Lending Home to try and address this problem. We're trying to do it differently with 5 minutes, you apply online, and you have a term sheet. Gives you all your loan terms, gives you your rate, and if everything, when we go through the full application and verify that you purported to be true, is true, that's the rate that you'll end up getting in the process. The rest of the process, walking through it, we try and make very fast and on your terms, on demand. The inconvenience of applying for a loan right now is somewhat mind-boggling. The fact that it's still on their terms and you have to call between 3 and 4 a.m. Central Time to get a hold of somebody. Right? That just doesn't work. Today's consumer is expecting 24/7. They're expecting to be able to upload their files to you in a secure and safe fashion. They want to know what's going on with the process. They want to understand where they are and what that looks like. And they want to do it when it's convenient for them, at work or at night.
When we started the idea of peer-to-peer lending, the idea was to go to a retail investor and have them finance these asset classes. And it's a logical idea because those retail investors today go to advisors who allocate with managers like PIMCO, who buy securities from dealers like Goldman, who get those securities from banks, who lend that money out. So the premise of cutting out that very expensive circuitous process seems like a huge opportunity. But it's proven to have some challenges to it. To get the rating agencies to come in and actually rate a transaction, you need operating history, performance history, capitalization of the business, team depth, all kinds of things you have to put in place to be able to go out and get a legitimate rating on a transaction. So the irony of this is, if you want to come in and disrupt financial services, you actually have to be a lot like financial services, right? So if you want to raise capital, you need to create a broker-dealer. If you want to lend, you need a lending license, whether you borrow a bank charter or you do it yourself like we do. You have to do one of those two things. If you want to tap the market for capital, you need the rating agencies. All these old archaic structures that were the cause of the whole disruption that we had in 2008 and 2009 are still firmly entrenched in the financial services picture right now. We ultimately decided to focus on student lending, which on the surface might seem like a weird thing to focus on because it's in the press all the time as a catastrophe and a bubble and a disaster. And it is some of those things. But it also is a $1 trillion market of which 65% of our cohort at the Stanford Graduate School of Business was borrowing from. But most importantly, it really fit this affinity idea, that the idea you should be able to get alumni to invest in a pool that lends to students, that creates this social bond such that if I default, it's transparent to you, right? And the idea is you address adverse selection and moral hazard in that construct and you create a better credit.